All right, welcome back, everybody. Another weekly webinar here with Prime Ag. This week, we're just going to touch quick on some of the volatility. We've seen some pretty volatile weeks here in the last couple of weeks, especially. So just wanted to kind of highlight, put some of those things into perspective. Here's D's corn. On our left side here, we've got the weekly trading range. You can see a lot of time spent, really anywhere between 35 up to 90 cents on this range. June 21 this week, currently we're at about a 26-cent range. So if you flip over to look and see what that compares to for a yearly range, that May 10th 90-cent range already takes out 2018 and 2017's trading range for the entire year. And then if you go up and look at the 21 yearly range so far, we've got a $2 range. You don't see anything like that until you get back into 2012 when we saw a $3.50 range. So, in years past, we kind of took a look, and typically what you would see just on a weekly note is 10 to 20 cent ranges, in corn. And here we're looking at about 35 cents at the low end to upwards of 90 lately. So, again, the volatility is here, and it's going to be here to stay for the near term. So what we've been doing on our report, if you've been following along, you can see that we like to do these fences. And the reason being is a lot of it has to do with this volatility as well as the uncertainty out there. We just want to put a trading range together because, frankly, it's pretty hard to tell where this market is going to end up come fall. I mean, we can see the argument for $7 corn. We can certainly see the argument for something like $4.50 corn. I think a lot of that obviously is going to come down to acres and production. So, we don't want to be sitting here with a bunch of bushels sold while the market's running up, and vice versa. We don't want to sit here with a bunch of bushels unsold and the market falling down to, say, $4.50 or worse. So again, that's why we're putting these fences together. Those blue lines represent a $5 put and a $5.20 put. That's a couple that we did recently with a $6.50 ceiling and a $7 ceiling. Those are prices that we feel we can live with, that if corn runs up, we're okay selling bushels there. The revenue is good. Chances are the following year, D22 has got a higher price. This is all good for your farm and for your revenue. So again, this sets up a trading range for price to go through as we continue out throughout this year and survive this volatility. You can see on the right the past couple of weeks where we've swung down to that $5 area and we've swung up to that $6.50 area. So we don't want to sit here unprotected. There's a lot of uncertainty over what a person's crop might be. So again, this is a good way to get coverage in place. You do have margin call when you sell those calls, so it is beneficial to have some bushels to offset those. Otherwise, you need to look at just buying puts outright. Over to the bean side of things here, again, we've got that trading range on the weekly side of things. I'd like to highlight the $1.90. When you flip over again to a complete yearly range, that takes out the trading ranges of 2019, 2017, and 2015 for the entire year. That was 1 week. Last week, we did a $1.90 move in beans. So again, a lot of volatility in here. That's a big difference, on a bushel of beans if you sell at the wrong time. So, again, 2021, if you look at where we are year to date, just on this range, 383. Once again, you have to go back to 2012 before you see these type of numbers. 2016, 2020 got close, but, to really see a significant jump, you got to go back to 2012. And again, similar to corn, in years past, the weekly ranges on beans has really been around 30 cents to 50 cents. Now 50 cents is kind of the new low. And again, we're seeing upwards of $1.90 on these trading ranges. So it brings up our November weekly chart again. We've been buying these puts. We did some cash sales, and now we're just content doing puts. The same thing applies here. Look at that blue line as a wall, a price floor for your bushels at 13 bucks. Anything, if price runs up higher, with your bushels, you're on board, you keep control of those. Just like corn, we don't want to be in a position where we have too much cash sold ahead and the market's flying up, or we don't have enough cash sold ahead and the market's headed down to $11.50, for example. So again, these puts budget some dollars. We have a few months here before harvest gets in, so the premium is ticking away. You can get these for a decent price. And again, it's just going to set a nice price floor. If you have uncertainty with your production, especially, these are a good idea. If you don't know what your bushels are now, okay, but then end up growing or producing, your APH, these puts help you not be committed to any elevators. This is all done on the board. There is no margin with these puts. You pay the premium and you're done. And these are going to give you that protection. Just like corn, when we go to beans, we can see the argument for $16 beans. We can see the argument for, $11.50, $12 beans as well. A lot of it's going to depend, again, on the acreage and where we sit in for production. There's a lot of marketing year left to go. We want to keep producers in control of their bushels. That's the main point here. But we also have revenue that needs to be protected, and we have to ask ourselves at what levels are we willing to protect this revenue on the worst case scenario. Quick look at the September Minneapolis wheat chart. Our point with this, okay, you've got those recent highs around 850 on this last run up. It's well known at this point that there is going to be some production loss and probably some acreage loss on spring wheat. Yet price isn't moving up above that 850 area. So for us, that just brings into question with corn and beans, if we do have these losses in production, are we going to see that significant move above the highs, or are we going to chop around maybe close to the highs? We don't know. All we're pointing out is with spring wheat, we do know that there's going to be some loss of production. And at this point, we are not moving past the recent highs. It's just something to be aware of. So to wrap this up with our final thoughts in here, okay, we've been putting this a lot on the report lately. Don't get too bearish on breaks or bullish on rallies. Again, this is why we like getting these puts and fences in place. We have called it a deferred decision. Set up a range, let this market work its way out, and see where the chips fall here as we move into, July and August. Crop ratings have been down, but so is price. We're really not seeing any big recoveries on these lower crop ratings. I think the market continues to look at the weather forecast and sees improvements for rain in a lot of these dry areas. We have some cooler temperatures going across the Midwest here in some areas. So right now, the battle between crop ratings and weather markets, we'd have to lean that the weather markets are winning the battle and favoring the bears at this point. Again, we talked about spring wheat. We know that there's problems out there, but we're failing to make new highs. And again, we continue to encourage guys to buy these puts and buy puts or fences for corn. So again, if you guys have questions, please let us know. You can email us, it's admin, ADMIN, @prime-ag.net. We'll have that down in the description below. And if you like what you see, you want to keep up with these posts, we put them out weekly. So subscribe to our channel, and we'll make sure that you get notified when a new webinar comes out. So again, if you have any questions, please contact us, and we are happy to help out. Thank you.